When starting newly in any venture or sphere of life, mistakes are bound to happen. Errors are inevitable, but some can be easily avoided if you are open to learning from other people's experiences, especially those ahead, with reasonable evidence of success. Not every investment mistake results in monetary losses. Likewise, not every great decision leads to success. Although there are mistakes new investors make that might be minimal and pardonable depending on the type of investment undertaken, errors in sensitive investments, such as investing in the wrong stock market or equity, can lead to a huge or total loss of capital. Therefore, for you to leverage your best in investment and avoid loss, you need to avoid the following mistakes. Lack of clear investment goals. Investing is more than having a lot of money, throwing it somewhere, then expecting a breathtaking return. You need to have investment goals that match your long or short-term goals. That should be the foundation of any risk that you wish to take. Everything from the investment plan to the strategies used, the portfolio design, and even the individual security should be configured in cognizance of the goals. Too many investors focus on the latest investment fad or on maximizing short-term investment return instead of designing an investment portfolio that has a high probability of achieving their long-term investment objectives. Neglecting after an initial loss. It's common for new investors to shy away from an investment when they experience a loss. The right attitude is to first accept the loss and terminate the regrets. Do not spend the entire decade mourning over your loss. Analyze your mistakes and then think of strategies that can forestall a recurrence. Instead of you saying a forever goodbye to investing, you can decide to recoup what you have lost. Tighten your financial belt for a while, then try again with the things you learned in mind. This will be your anchor the next time the market gets shaky. Don't make the mistake of neglecting an investment if you are sure of its profitability. Not understanding the investment. Warren Buffett, one of the most successful investors in the world, advises against making investments in business whose business strategies you are unfamiliar with. It will be easier for you to gauge the legitimacy and certainty of the return on investment if you have a basic understanding of how the company you want to invest in operates. People frequently invest in platforms without having a thorough understanding of how the company runs, and as a result, they ultimately lose their money. However, creating a diversified portfolio of exchange-traded funds, ETFs, or mutual funds is the best approach to avoid making this error. If you decide to invest in particular stocks, be careful to fully comprehend the businesses those stocks represent before you make a purchase. Avoid the one-size-fits-all, the cheap, the simple, and the future-knowing investment agencies. There are no freebies or guaranteed things on Wall Street, and veering from traditional equities and bonds introduces more risk to your portfolio. When an investor's main priority is saving money, he will typically get the value. Failing to diversify. As a new investor, you need a full understanding of the terms asset allocation and diversification. As a general guideline, don't devote more than 5% to 10% of your overall portfolio to any one investment. Asset location divides your portfolio between equities and income securities, while diversification limits the number of individual portfolio holdings in at least 3 different ways. Both of these activities are neither market timing tools nor hedges. Mutual funds cannot be used to perform either of them. The working capital model, or another cost basis approach, is the most effective way to handle both. Adequate diversity is the only way to build a portfolio with the potential to offer suitable levels of risk and return in a variety of market circumstances. Some investors believe that taking a big investing exposure in one security or industry will enhance their returns. However, it might be fatal if the market shifts against such a concentrated position. On the other hand, your performance may be impacted by excessive exposure and diversification. The greatest strategy is to strike a balance. Lack of patience. Investment is not a get-rich-quick scheme, but rather a gateway to building sustainable wealth. Hence, be patient with your investment plan. Even though investment is always described as long-term, neither investors, the media, nor financial counselors frequently discuss it in this manner. Never regularly change course and always make small adjustments rather than big ones. Short-term market value changes should not be compared to averages and indices that are unrelated to portfolios. There is no index that that your portfolio can be compared to. There is no connection between calendar subdivisions in market, interest rate, or economic cycles. Long-term returns will be higher when portfolio growth is gradual and steady. A portfolio should only be used for the purposes for which it was created. Any other use would be disastrous. This means that you must maintain reasonable expectations regarding the pace of portfolio growth and return. Therefore, stick to your action plan and avoid having unrealistic expectations or using those of others. Without knowing you, your goals, and your present asset allocation, no one can tell you what an acceptable rate of return is. Placing emotions above sound reason. Emotion is arguably the biggest detractor from investment return. Fear and greed control the market. When faced with any kind of negative return, an investor who is driven by emotion may quickly recoup when in reality, he would have been better off keeping the investment for the long run. Patient investors are usually rewarded. Likewise, it's all too easy to fall in love with a company you've invested in when you see it succeed and forget that you bought the stock as an investment. Never forget that you purchased this stock to make a profit. Consider selling the stock if any of the fundamentals that led you to invest in the firm alter. Don't let the success of the company overshadow your discernment. Too much information. Avoid letting analytical paralysis impair your ability to make decisions. Confusion, hindsight, and the inability to discern between research and sales materials, which are frequently the same document, are symptoms of information overload. Long-term success depends on a rather restricted emphasis on data that backs up a reasoned and well-supported investing strategy. If possible, avoid using future forecasters. Ensure to read only information that will guide and help you make profits as regards your investments. Too much knowledge about the investment that is not specific can hinder progress and lead to a loss of investment. Less information. While too much information is bad, less information can be destructive. You must gain enough knowledge on how to handle fluctuations in market value, whether positive or negative. You must consistently examine your portfolio's income and growth components independently. Changes in market value must be anticipated and understood rather than being met with panic. So don't settle for less information and don't go for too much information. Just focus on the needful. Get-rich-quick mentality. Any shortcuts or gimmicks that promise immediate success with no effort should be burned, deleted, or thrown out the window. Avoid letting your portfolio mix mutual funds, index ETFs, partnerships, penny stocks, hedges, short sales, strips, commodities, options, currencies, with many others. Although it might be impossible to live without the anxiety of getting a return on investment as quickly as possible, holding tight to the get-rich-quick mentality will distort your focus. This might cause you to lose your investment, as it will warrant frequent changes in investment choices. Hence, another return killer is constant turnover or changing roles frequently. The transaction expenses alone can drain you, not to mention the short-term tax rates and the opportunity cost of missing out on the long-term returns of otherwise investments. You can only overcome this if you are an institutional investor with access to low commission rates. As a new investor, shut the door against get-rich-quick schemes and opt for long-term investments. Speculation and pessimism. People will deceive you into worrying when prices drop and buying at market peaks while you ignore all cyclical possibilities. Never stack your portfolio with current story stocks at exorbitant prices. Purchase quality companies incrementally at reduced cost to avoid the frustration of conventional investors who buy high and sell low. Buying high and selling low. Why do so many investors choose to buy high and sell cheap, which is the basic investment tenet? Fear or greed drives many investment decisions rather than reason. Instead of attempting to meet long-term investment objectives, investors frequently buy high to maximize short-term profits. The latest financial fad or trend, as well as assets or investment techniques that were successful recently, are all products of a concentration on near-term returns. In either case, it gets harder to have a competitive advantage when estimating an investment's value after it becomes well-liked and attracts the public public's attention. The sensationalism that the media injects into the process of managing investment portfolios exasperates the issues that investors encounter. I believe you now have more than enough to guide your feet as you make investment choices. I am certain that you want to avoid all of these mistakes and not be caught in the web of frustration birthed by continuous losses or little return on investments. Thanks for watching.